Markets continue to make new highs, with the S&P 500 logging its 30th record close this year. A few minutes ago, KKR released its outlook for the second half of the year, titled Opportunity Knocks. For more on this and the markets, we want to bring in Hency McVey. He's Chief Investment Officer of Balance Sheet at KKR. And Henry, welcome. It's good to see you.
Thanks for having me.
Let's talk a little bit about this. You say opportunity knocks. What's different than 6 months ago when the outlook that you all put out was glass half full?
I think largely the same in terms of that we think the market is going to grind higher. I think there's probably going to be some more election uncertainty and political uncertainty as we head into the second half of the year. So our point was, don't complain about the noise if opportunity is knocking. I think when we look around the world right now, our businesses are actually picking up. Our infrastructure business continues to be really strong. What's different we're seeing right now is in the private equity side, there's a lot of activity around corporate carve-outs. A lot of big companies around the world have actually, they want to shed kind of unprofitable or less productive subsidiaries. So that's busy. And then I'd say, look, in the public markets, I mean, we focus mostly in the private. Biotech's gotten beaten down. That's interesting. Energy is still interesting to us. And I think within credit, there's a huge wave of refinancings. And so when you look at what's happening on the supply side, there's actually not a lot of credit creation. So, I was recently in Europe, and you see this in the U.S., about 40% of the debt issuance right now is just refinancings. And so these companies need to refinance. They're doing it at higher rates. And I think that's been a pretty productive environment for a lot of our credit investors, particularly our insurance companies that we do business with.
Meaning that you can get a much better place for it?
Yeah, I think that you don't have to, think about this. We have an inverted yield curve, so you can be 3 years or less on duration, pick up high single-digit yield, and in many countries around the world, you can actually get a positive currency roll down because the dollar's been so strong. Yeah. And so that's really effective. Most of our pensions and our insurance companies, they've got kind of 5 to 6 to 7% liabilities out there. We've left that world of, we've talked for years, we've left the world of kind of zero interest rates, and this new normalization, it's leading to a lot of CIOs wanting to do more, I'd say, broad-based kind of asset allocation. And, the last couple of years when rates were just going down the whole time, what'd you do? You bought, venture capital, and you bought long-duration investment-grade debt. What you're seeing today is people are being, I think, much more thoughtful and much more proactive around short-duration credit. Let me have some infrastructure, CLO liabilities, equities that have dividend yields. One of the things in the piece we talk about is, look at the home builders. A lot of them are just buying themselves back. They're like public buyouts of themselves. And so there's a huge amount of capital, which is the result of us probably putting too much money in the system post-COVID. And so, but that capital is now starting to find a home in different avenues. And you're seeing kind of this break between people who are being thoughtful about that capital allocation and those that aren't. And for our firm, that's a pretty interesting opportunity set.
Infrastructure, that's simply government spending that's funding all of this?
I think what's happening, though, is there's a mismatch between energy demand and energy supply, right? A lot of the headlines today are about NVIDIA, the chips. We're spending all our time on the back end, which is electricity demand has gone from zero growth for a decade up to almost 3%. And if you think about that in the U.S., what it's doing to the grid, it's putting huge strain on it. So if we're right about our estimates for AI and that demand for energy, that's the equivalent of adding 24 million homes to the U.S. grid set. Think about that. That's a massive number. And so what it means is if you have the infrastructure around the energy, if you can actually connect the energy to where the AI demand is, there's a huge benefit. So data centers, data, fiber, towers, all those things are going to continue to benefit. And then at the same time, there's just a lot of creaky infrastructure. We own generally 150 to 200 companies around the world. Post-COVID, they're restructuring their supply chains, right? They're coming to Mexico. They're going to Europe. They want resiliency. Power goes out in Mexico. You have a flood in California. And so that's creating a much more robust CapEx cycle than in the past.
In the U.S., though, that's a highly regulated arena and one that takes ton of time for permitting. Is that something you focus more on overseas than here, or are there ways around the regulatory process?
We're not going to be building the transmission line that takes it, which is slowing down, but there is a lot of activity around data, companies spending just to build resiliency. So I wouldn't think about it just as like putting a transmission line up. There's a huge... You're
thinking about the data center itself?
Yeah, and if you think about that, there's a lot of connectivity. You have to cool the data center, right? I mean, there are lots of different ways to play that. The big story, though, globally that's going on is U.S. productivity, right? If you look at money is coming into the United States, we are seeing in the last 4 or 5 quarters productivity go up to about 2.5%. It's been about 1% for a decade. And if that continues, that will continue to bring more money into this country, and ultimately it will create a lower cost of capital.
Henry, your point that I think is really important and really interesting is that we no longer see stocks and bonds offsetting each other, where if one goes up, the other goes down. They're now far more correlated, and that can mean some real pressures to your portfolio.
This is a huge deal. Thanks for highlighting. I mean, what's happening for 20 years when stocks went down, government bonds rallied. Now we have huge deficits. There's always some Achilles heel in the story. The consumer's over-levered, corporate's over-levered. This time the government has most of the debt. And what's happening to portfolios is we're not actually seeing single asset volatility of different assets go up. We're seeing that relationship between stocks and bonds. But if you're on a board of a pension or endowment or whatever, you should know your benchmark is getting a lot more volatile because that relationship's changing. And what we see the most thoughtful CIOs trying to do is they're trying to find things that are less correlated to that relationship. So, whatever you learn the last 20 years about asset allocation and macro, you need to throw that out the window and think differently about that. And there's some really interesting analysis in the piece about that, and I think that'll garner some attention.
What do you do, though? What is less correlated? Because I think of things like cryptocurrency, that tends to be pretty correlated to the tech stocks, and questions around the Fed.
A couple things you can start with, which is don't have such long duration because you're going to be more susceptible to bonds. The second thing is you need to diversify across a broader suite of products. So again, own some CLO liabilities, own some infrastructure, own some different forms of credit, and then within equities, there's both a home for both public and private. I think we were in this period where the more that you own growth and the more that it was all in the terminal value, that worked great when the Fed was suppressing rates. Today, I think we're in this higher resting heart rate for inflation, and certainly given the deficits, that means you can't use the old playbook.